Welcome to this quarterly business review focused on Meta Platforms' Q3 fiscal 2025 analysis. We'll examine the financial resurgence against the acceleration of structural investments. In our executive summary, we highlight three key areas. Core momentum saw ad revenue grow 26% year-over-year. A one-time tax charge of $15.9 billion under the OBBBA Act drove the effective tax rate to 87%. Lastly, AI aggression is marked by a $13.8 billion scale AI investment and FY2025 capital expenditure guidance of $70 to $72 billion. Meta's advertising engine showed resilience with $51.2 billion in total revenue. Family of apps revenue was $50.8 billion, a 26% year-over-year increase. Growth was balanced, with APAC showing strength in impression growth, and online commerce being the top vertical driver. The balanced ecosystem dynamics are evidenced by a 14% increase in ad impressions and a 10% rise in average ad price. This double-digit growth in both volume and pricing suggests Meta is effectively utilizing AI-driven improvements to overcome prior signal loss challenges. However, operational margin compression occurred. The operating margin decreased from 43% to 40%, as expense growth of 32% outpaced the 26% revenue growth. Structural cost escalation is driven by two main factors. Research and development, focused on AI, grew 35% year-over-year. General and administrative costs surged by 88% year-over-year due to intense legal and regulatory compliance pressures globally. Meta's infrastructure pivot centers on a generational capital reallocation. A $13.79 billion strategic investment in Scale AI secures critical training data. Efficiency is a focus through optimized GPU utilization and data centers, while an accounting extension on server lives aided near-term gross margins. Segment divergence shows Family of Apps reporting $25 billion in operating income. Reality Labs revenue grew 74% to $470 million through Quest and AI glasses, but operating losses remain significant. The operating loss for the quarter was $4.4 billion, essentially flat with the prior year period. The aggressive capital deployment plan is substantial. Fiscal 2025 Capex guidance is $72 billion. Despite total commitments exceeding $139 billion, Meta's 9-month free cash flow of $29.5 billion is robust enough to fund this massive infrastructure expansion. Regulatory and litigation risk remains high. In Europe, the subscription for no ads model poses a risk to Q4 revenue. The US FTC has ongoing administrative proceedings, and litigation regarding youth safety and privacy cites potential class action damages in the hundreds of billions of dollars. Examining the strategic liquidity position, liquidity stands at $44.45 billion, down $33.3 billion since the end of fiscal 2024. Long-term debt is stable at $28.80 billion, and equity investments include the $13.8 billion Scale AI stake. Total commitments are $139.3 billion. In summary, Meta Platforms delivered a quarter of sharp contrasts. Its core advertising engine was very strong, with accelerating volume and pricing, showing real resilience. But reported results were overwhelmed by a one-time $15.9 billion tax charge, while margins were pressured by surging AI investment and rising legal costs. The bigger trend is clear. Meta is deliberately reallocating capital toward AI, accepting near-term margin and cash flow pain to secure long-term positioning, even as regulatory and legal risks become a recurring cost of doing business. Underlying operating earnings are improving, but headline GAAP earnings collapsed this quarter. Looking ahead, ad strength should continue, but margins stay under pressure, with Europe now the biggest near-term risk and AI spending extending well into 2026.